As we head towards the opening bell on this Monday, November 10th, shares of Navitas Semiconductor, ticker NVTS, are indicating a significant move. The stock closed the previous session on Friday at 7.84, flat for the day, but in this morning's pre-market trading, it is surging, currently quoted at 8.33, which is a jump of 49 cents or over 6.25%. Now, on the surface, this pre-market spike looks like pure bullish enthusiasm, a continuation of the AI-driven narrative that has captivated investors. But what the market seems to be ignoring and what creates a massive disconnect is the data we just received. Only 1 week ago, on November 3rd, Navitas reported its third quarter earnings, and to put it bluntly, the results were not good. The company missed analyst expectations on both earnings per share and on revenue. Even more concerning, management delivered a severe guidance cut for the fourth quarter, projecting revenue of just $7 million, far below what the street was anticipating. This guidance was attributed to a strategic and painful decision to exit the low-margin China mobile business. Following that report, the stock fell over 9%. So the immediate question we must ask is, why, just 1 week after such dismal news and a forward-looking forecast that implies a significant revenue decline, is the stock bidding up over 6%? This is the central tension in Navitas right now. The expectation, the story that is clearly winning this morning, is Navitas 2.0. This is the narrative that the company is successfully executing a high-stakes pivot, intentionally shedding its low-profit, commoditized mobile charger business to focus exclusively on the high-power, high-margin future of gallium nitride and silicon carbide chips. The market hears this and immediately connects it to the biggest secular tailwinds that exist: artificial intelligence data centers, electric vehicles, and solar infrastructure. The partnership with NVIDIA to co-develop power solutions is the poster child for this bull case. Investors see this pre-market jump as a sign that the market is willing to look past the current bottom in revenue, betting that this transition will unlock a much larger, more profitable company. But then we must confront the reality. This pivot is not just a simple business decision. It is a profound and costly gamble. The reality is that Navitas remains a deeply unprofitable company. Recent reports show operating margins that are staggeringly negative. The company is burning through cash, and while it has a decent cash position for now, this strategic shift requires immense investment in research and development, just as its primary revenue stream is being voluntarily shut down. This isn't a transition from a position of strength. It's a fundamental re-engineering of the entire company in real time. The reality is that while the AI data center market is a massive opportunity, Navitas is competing against entrenched giants like Infineon and Wolfspeed, who have deeper pockets and established customer relationships. The stock is currently trading at a sky-high price-to-sales valuation, a multiple that is nearly 10 times the semiconductor industry average. This valuation is not based on current profits, because there are none. It is 100% based on the hope that the Navitas 2.0 story comes true and quickly. This brings us to the most critical and perhaps most misunderstood aspect of the stock right now: the short interest. There is a massive bet being placed against Navitas, and it's not by small players. According to the most recent data from mid-October, a staggering 45.5 million shares are held short. This represents nearly 30% of the company's entire free-floating stock. This is an exceptionally high number, far exceeding the average for its semiconductor peers. The immediate reaction many retail investors have when they see a 30% short float is to yell, "Short squeeze." This is the expectation. Many are likely buying this morning, thinking this pre-market pop could be the start of a squeeze that forces those 45 million shares to be bought back. But again, we must look at the reality, which is found in the deeper data. A short squeeze is not just about a high short interest. It's about trapping those shorts. The key metric to watch here is the days to cover, or short ratio. For Navitas, that number is incredibly low, at last check sitting around 1 to 1.5 days. What this means is that because Navitas trades with such enormous daily volume, all 45 million shorted shares could theoretically be bought back and covered in just over one trading session. This high liquidity means shorts are not trapped. Furthermore, the cost to borrow shares of Navitas to sell them short is very low, recently reported at under 1%. When a stock is difficult to borrow and the borrow fee spikes, it signals panic among shorts. We are seeing the opposite. This data suggests that while the short position is large, it is not distressed. It is a calm, calculated, and well-capitalized bet that the company's valuation is disconnected from its fundamental reality of widening losses and a risky, unproven business transition. The short thesis isn't that GaN technology is bad. The short thesis is that Navitas is burning too much cash and is valued too richly to survive the transition and win against its giant competitors. For investors trying to navigate this is what you need to know. You can track this data yourself. You can go to financial sites like FinViz or Fintel and look up the ticker NVTS. Do not just look at the short float percentage. You must also look at the short ratio, or days to cover. A number below 3.0, especially one near 1 like Navitas has, suggests that a sustained, forced squeeze is very unlikely. The shorts can get out too easily. This is a battleground stock, and the options market confirms it. The volume put-to-call ratio has been leaning bearish, with a ratio over 1.2, meaning more bets are being placed on the stock falling than rising, even as open interest on calls remains high. The implied volatility is over 100%, which is the market's way of saying it has absolutely no idea where the stock will go next, but it expects the move to be violent. What's your take on this Navitas 2.0 pivot? Is it a brilliant strategic move to capture the AI boom, or a desperate attempt to hide the failure of their mobile business? Let me know in the comments. So what does Navitas Semiconductor actually do? The company is a pure play on next-generation power semiconductors. It designs and markets gallium nitride and silicon carbide chips. These are not the brains of a computer like an NVIDIA GPU. These are the muscles. They control the flow and conversion of electricity. Their key advantage over traditional silicon chips is that they are dramatically more efficient, smaller, and lighter. They waste less power as heat. This is why they are essential for applications where efficiency and density are critical. Fast-charging laptop and phone adapters, power supplies for massive AI data centers, onboard chargers for electric vehicles, and inverters for solar and energy storage. The company has been positioning itself as the only pure play that offers both GaN and SiC technologies, claiming it can service the entire power spectrum from low-voltage consumer applications to high-voltage industrial and automotive systems. The future outlook, therefore, is a race against time. The company's management has essentially asked the market for patience. They have guided Q4 revenue into the ground, claiming this is the trough. They are projecting a hockey stick recovery as the new design wins in data centers, solar, and EV ramp up into 2026 and 2027. The bull case is that by 2027, Navitas will be a high-growth, high-margin powerhouse that completely dominates the next-gen power space, and that this pre-market price of 8.33 will look like a distant memory. The risk, and the reality that the shorts are betting on, is that this ramp-up takes too long. They are betting that the cash burn continues, that competition eats into their projected margins, and that the company will ultimately be forced to dilute shareholders by raising more capital at lower prices just to survive. The market's enthusiasm for AI might not be enough to fund these losses indefinitely. As we move into this week, we will be watching to see if this pre-market strength can hold after the opening bell. Is this a genuine reallocation of institutional funds betting on the long-term Navitas 2.0 story, or is it a short-term sentiment-driven pop that will fade as the reality of the Q4 guidance sets back in? The signals to monitor will be institutional filings to see if large funds are truly adding to their positions, and the options chain to see if the bearish volume begins to subside. Comment below with how many shares of Navitas you're holding and if this high short interest worries you. In the end, this stock is the perfect example of the market's core conflict. The expectation is a disruptive technology company partnered with NVIDIA attacking the world's fastest-growing markets. The reality is a deeply unprofitable business with a collapsing legacy revenue stream and a valuation that is priced for perfection it has yet to deliver. This morning's pre-market action shows that for today at least, the story is winning. But the 45 million shares held short are a powerful reminder that the fundamentals have yet to be proven.